All right, we're going to get started. Good morning, everyone. I'm Anna Paulson. I'm the Director of Research at the Federal Reserve Bank of Chicago, and beginning in July, I'll be the President of the Philadelphia Fed. That was not a plea for applause. I just want to say how much I'm appreciating this conference, both for the opportunity to hear a wide range of perspectives on issues that are really important to the FOMC's monetary policy framework, but also because of the opportunity to honor Thomas Laubach and his legacy. So in this session, we're going to continue the conversation about communications, and Ben Bernanke, who literally needs no introduction to this audience, will present some ideas about how to improve the FOMC's monetary policy communications. And our discussant, Bill English, Bill spent 25 years at the Board of Governors, notably as Director of Monetary Affairs and as Secretary to the FOMC. He's currently on the faculty at the Yale School of Management, which I suspect provides many practical opportunities to practice communicating about central banking to MBA students. So with that, let me turn it over to Ben.
Good morning. Let me first say that I'm very appreciative of being part of this conference in honor of Thomas Laubach. He was my graduate student. He was my co-author. He was a valued staff member here at the Fed when I was chair, and he was my friend. So thank you for doing this for Thomas. I'm going to make a proposal today, which is intended to add a tool to the Fed's toolbox, which I think will, in a perhaps subtle way, improve its communication, especially at times of uncertainty like now, but it has other advantages as well, which if I have time, I will get to. Now, a lot of the paper is about an assessment of the Fed's communication and a comparison of the Fed's communication with that of other advanced economy central banks. Now, one thing that you notice when you do this comparison is that the Fed is basically very laggard in its approach to transparency. We didn't have an inflation target till 2012. I was just in New Zealand celebrating the 1990 adoption of an inflation target. We didn't have a press conference till 2011. Didn't have a press conference at every meeting until Chairman Powell made that change. So we've been generally fairly laggard. But for the most part, not entirely, but for the most part, the Fed has got some of the same tools, the press conference, the statement, the minutes, and so on, as other major central banks. There are two elements that the Fed has that others do not have. One is the summary of economic projections, which everyone's familiar with, and I will talk about a lot today. The other is the semi-annual report to the Congress, which I will argue it's an empirical fact that it gets absolutely no attention from anybody. And I talk about that in the paper. I will not mention it again in this remarks. And in particular, it is not a substitute for the proposal I'm going to make. All right. So what does the FOMC communications lack? I argue that virtually all peer central banks, literally all peer central banks, offer information, background, and context about the policy decision at the time of the policy announcement. Okay, in particular, again, virtually every central bank, and we have a panel coming up and they can talk about their own experiences, releases at the time of the decision a so-called monetary policy report. And what that is, typically, is first a review and analysis of economic and financial developments since the last meeting, some special topics and deep dives about issues that are of particular importance, and importantly, a macro forecast, a transparent, complete, and comprehensive macro forecast done by the staff, typically with some kind of input from the policy committee. Now, having a timely monetary policy review has, I think, substantial advantages. Transparency. What is the committee looking at? What are the things that concern them? What is likely to determine their future policy choices? By essentially showing part of the briefing, by talking about what the committee is looking at, by talking about the state of the economy, the NPR enhances transparency and helps people understand the decision and what's likely to follow. Second, insight into the outlook. If you have a forecast that has a set of assumptions, a model, et cetera, and some forecasts at different horizons, it will help people understand why is the Fed forecasting, for example, more inflation? What are the factors associated with doing that? And a comprehensive, internally consistent, and transparent forecast can do that. And then finally, better communication. I'm going to focus, some of you may know that I've been sort of crusading recently for alternative scenarios, and they've come up a lot in this meeting, and just in Ricardo's presentation and Savannah's presentation yesterday when you're talking about stress testing forward guidance, that you have to use alternative scenarios to do that. But one of the advantages of having a baseline forecast is that you can use it as the starting point for doing various alternative scenarios. And in particular, it helps communicate that the outlook is very uncertain, that people don't always appreciate, and that the central bank has a reaction function. That is, it will respond to changes in the economy. And what I'd like to do is give a very, very illustrative and cartoonish set of examples. Please do not interpret these literally. Do not think of them as criticism. I just want to illustrate how using alternative scenarios when there's uncertainty can help you be more effective. So example number 1, 2021. The basic message the Fed was sending was, based on current information, the most likely scenario is that the increase in inflation will be transitory, full stop. And this is what we're going to do about it. But suppose we had added at that time what's in bold. But if inflation proves higher and more persistent than expected, we will do this. We will suspend QE. We'll start to raise rates, for example. If inflation is transitory but growth is weaker than expected, we will do that, a different thing. So what that does is it shows the public the uncertainty of the forecast. It shows the reaction function. And in this context, it would help people understand in advance how the Fed would pivot if the situation evolves in a different way. And I think that's a very substantive improvement. Second example, so I picked on the current Fed. Let me talk about the Bernanke Fed. 2012, roughly speaking, the QE3 announcement said that QE3 would continue until labor markets show substantial improvement. How could you have expanded that? Well, first of all, you could be a little more quantitative in that particular scenario, meaning a decline in unemployment of so many percentage points, for example. What does substantial improvement mean? But it's also been useful, have been useful to have had an alternative scenario. If substantial improvement has not occurred in the next Y months, or if financial stability concerns become severe, then asset purchases will be phased out over a period of approximately so many months. Now, if you'd done that, conceivably, it would have perhaps avoided, without doing Ricardo's whole schmear, might have avoided the taper tantrum. Now, recently, the use of multiple scenarios in talking about uncertainty and reaction functions has become a lot more popular. Jay has talked about, depending on whether inflation is persistent or not, from the tariffs. Governor Waller had a nice speech that was explicitly about 2 scenarios for tariffs and how they might affect inflation. The Bank of Canada's latest policy announcement did not even give a baseline scenario. It said, here are 2 scenarios, and here's what we're thinking about in both contexts. And the IMF's World Economic Outlook, which just came out, which gives growth projections for the global economy, was, again, didn't have a central forecast, or it did, it was called a reference forecast, and it had 2 scenarios, 2 possible. So what this does is it shows uncertainty and lets people understand that there's not a single forecast, rather the central bank is preparing to respond to different contingencies. So my proposal is basically to do the same thing for the Fed. Again, make us the last central bank to do this, which is to release an abbreviated monetary policy report led by board staff with Federal Reserve Bank contributions. It would have the normal things, recent developments, deep dives, special features, but it would include a staff forecast of key macro variables and transparency about what's driving those variables and the underlying economic assumptions. And there would be selected alternative scenarios as well. Now, something I may come back to, there are issues of governance. I think they could be solved. One of several possibilities, and I'll come back to others, is that the choice of alternative scenarios and the reaction function that is shown is an important piece of communication. So what I would suggest would be that the staff provide, with the chair's instruction, 4 alternative scenarios to show to the committee on the first day of the meeting, and they would decide which, if any, to release. So there would be input into that important decision. Now, it would be nice to have an FOMC consensus forecast. If you read the transcript for 2012, you'll see why we don't. It was a terrific mess. Basically, you have 19 people. They are scattered all over the country. They have radically different views, and it was just not possible to come to a consensus forecast. It's not that bad, though, because I don't know how many people know the Romer and Romer 2008 paper, which show that, at least as of that time, that the FOMC projections were the staff forecast plus white noise. So there's really not a lot of additional information in the FOMC consensus forecast. Now, the question is, well, why not? What about the summary of economic projections? You know, these get a lot of attention, and they were pretty informative, and I think they were very useful, frankly, during the ZLB period. But I discussed in the paper 4 reasons why they are not adequate. The first is that they are made before the meeting and rarely revised, and because the meeting could lead to changes in view, or because the chair could create some kind of new compromise, whatever, the projections made before the meeting may not reflect the post-meeting consensus, which makes communication more difficult. Secondly, the dot plot is de facto forward guidance, which again may not be what the committee wants to do. And in particular, 2 things. One is it can't do state contingent forward guidance because it ignores, all but the modal state. And it can't deal with a situation of high uncertainty where they don't want to offer guidance. Like, the committee may talk about data dependence guidance. They may talk about meeting by meeting decisions. And then you've got the dot plot showing the next 3 years of interest rates. Those 2 things are not quite consistent. The projections obviously are not transparent. They don't tell you what the assumptions are. They don't tell you what the analysis is based on. If the projections change from one meeting to the next, you don't know why. So that's, I think, a problem. And then a little more subtly, but there's a huge focus in the media on the median projections, particularly of rates, but also of macro variables. And that focuses everything on that central scenario, transitory inflation, and doesn't give any space. There's no way to take projections and do alternative scenarios. It's just not logically possible. It de-emphasizes the uncertainty, and the very strong advantages of being able to do alternative scenarios are lost. Now, there are objections to releasing a forecast. I'm sure that Bill will be very extensive on these. 2 that I hear from the staff. One is the demands on their resources. I can hardly take this seriously. There are countries with populations of 5 million that put out NPRs. There would be no difficulty, particularly since the NPR could be done jointly with the briefing to the FOMC. Another thing I hear from staff is it would inhibit their ability to be frank with the FOMC and that also I don't think is a valid argument. First of all, the standard forecast would do what they do now, which is assume fiscal and other policies which are relatively close to what is currently happening or is expected to happen, would not be controversial. If the committee wanted to explore a sort of a radical different possibility, what happens if fiscal policy is much, much more expansionary than expected? If it's a small probability, they could just do it internally. They don't have to release that. If it's a large probability, I think they have a responsibility to release it. And what you've seen, for example, in the run-up to Brexit, the Bank of England shouldered its responsibility and said, here's what's going to happen if you vote for Brexit. And it was very controversial, but that's part of the responsibility of the central bank, is to talk about what will happen if a non-modal but still fairly likely scenario comes to pass. I think a staff-led NPR would get attention. Observers know the briefing materials are influential. Again, it's just white noise. The ECB is a very similar structure to the Fed, and it has no problems. The staff forecast for the ECB, and Philip Lane is here, he can talk about it. It's very influential because the policymakers talk about it in their remarks, and they reference it in the press conference and in the statement. So if the FOMC members are basically saying that they think the staff forecast is important, then the markets will think it's important. The last 2 comments, I think could actually bear on what's certainly going to be a discussion point, which is the governance issue. You know, the FOMC is not jointly making the forecast, but there are various things it can do to influence the forecast and to evaluate the forecast. In particular, first, the FOMC would be able to influence the forecast through various channels. Two possibilities. One is to have a pre-meeting call where there's a discussion of the forecast and gets input from the FOMC. Another possibility, which I've already mentioned, is the deciding at the FOMC meeting which alt-sims to release. Now, the final thing, this is important. Most people don't know this. When the secretary writes to the FOMC participants and asks them for their projections, they also ask them for verbal responses to a series of questions of the form, why are you projecting what you're projecting? Do you agree with the Teal Book forecast? Do you agree with the Teal Book's rate forecast? That should be published or something. What could be done easily enough, without changing anything that's happening now, is take those answers, use AI, summarize them into a summarize them into a 2-paragraph summary. You know, just like in the minutes, most FOMC participants thought that the Teal Book scenario was reasonable. A few thought it was too hawkish or whatever, and that would provide as much information, really, in terms of what the committee thinks as the best collective judgment of the Bank of England does now. Now, I have, with the great help of Alex Connor, my RA at Brookings, we put together and so just in terms of resources, he and I, put together a kind of a mock-up of what the NPR might look like. Here's the table of contents. I won't go through it. If you are extremely masochistic, you might choose to look at it and sort of get a sense of what we're doing. But the idea basically is you have a macro forecast, but then you look at in more depth at labor markets, at inflation, at monetary policy, discuss risk and uncertainty and alternative scenarios, again, which are chosen by the FOMC. On risk and uncertainty, let me address that just really quickly. That's another thing that the SEP does not really address. There is, in the SEP, the question, is uncertainty greater or less than the last 20 years? And are the risks to inflation and unemployment to the upside or to the downside? Totally qualitative. Okay? Doesn't say anything about how big the risks are. Doesn't say anything about where the risks are coming from. Doesn't say anything about how the Fed would respond to those risks. So the treatment of risks and uncertainty in the current SEP is inadequate, and this would give the chance for the staff to write out and explain what they see and maybe use an alternative scenario. Now, I would be okay with dropping the SEP entirely, frankly. I don't think it has a lot of problems. But probably, since it does, people are kind of used to it, at least for a while, probably you could retain it. And there are a couple of ways to improve it. I will talk about the two ones in bold. One is, once again, to release summaries of participants' written comments. So at least we would have a written description of why is the FOMC or the participants predicting higher inflation than they did last quarter? Well, most participants thought that oil prices would remain higher than was previously anticipated. That kind of thing would help people anticipate, understand the projection. And the second thing is to de-emphasize the median projection that comes out of the SEP forecast is the median of the average of the mode. Am I wrong? So, it's not entirely clear what it means. So there must be ways to emphasize uncertainty. One way to do that would be to ask the participants to answer the following question: what do you think is the most likely significant alternative scenario, and how would you think we ought to respond to that should it happen? That would give you a qualitative approximation of an alternative scenario. Okay, so let me just conclude by saying, there are certainly many objections people can think of to this plan. I would like to point out once again that every single advanced economy central bank in the world, there may be exceptions, but I don't know of any, other than the Federal Reserve, do this, and they all have different structures, they have different resources, they've solved the problems. We wouldn't have to invent these things from scratch. So, you know, I just think it'd be obviously possible to do it. Now, what is my forecast? I'll end with my forecast. Between New Zealand adopting the inflation target and the Fed adopting the inflation target was 22 years. So I think that by 2047, this is definitely going to be in place, and I hope a little earlier than that. But quite seriously, I think there really is a movement towards treating uncertainty in the forecast more seriously and thinking more about the reaction function. How would we respond if that happened? And the only way to do that is to have a true forecast and the ability to construct alternative scenarios. Thank you.
Okay, thanks very much to the organizers for inviting me to participate in this terrific event honoring Thomas Laubach, who was a colleague of mine for many years. And thanks to Ben for a very interesting paper, a provocative paper, and especially for providing a detailed example of the document he had in mind. I think that helps to clarify the discussion. I always thought he would have been a great member of the MA staff, and I was right. I was absolutely right. So my plan is to provide a very brief summary, since Ben already presented his idea, and then give some reactions. My job, as usual, when I was at the board, and so was Ben, is to throw cold water on his innovative ideas, so I will do that. I have 3 concerns, things that I worry about, 3 questions that I just don't know the answer to, but the committee would have to figure out the answers to. And I'll end by providing an alternative B to Ben's full-throated alternative C. So summary, Ben is right? Current Fed communication around policy decisions includes relatively little explanation. The statement's pretty brief and qualitative. The SEP doesn't have any kind of explanatory text saying why the forecast is what it is. The press conference is potentially good, but it kind of depends on the questions that are asked. And the prepared text generally kind of follows the statement. So Ben's proposing a new document, the Economic Review. It would have information on current economic and financial conditions. It would have a forecast with a description of why the forecast is what it is. It would have boxes on special topics, and it would have alternative economic scenarios. As Ben points out, this is basically information that's already in the Teal Book. So this isn't a big lift, and it certainly is possible that this could be produced and published on the schedule he suggests. In addition, he proposes improvements to the SEP. I like those. I'll return to them at the end. But taken together, this would provide a lot of improved communication around policy decisions and move us into greater alignment with other major central banks. I'm not sure I value that as much as Ben does. If they're doing, if your friends are jumping off a bridge, do you want to jump off the bridge? No, maybe not. I talked recently to a very wise person about these issues, and they said it's always the case that significant changes to communication seem risky. Nonetheless, over the last generation, we've made a lot of big changes to communication, and they've mostly been successful. So we shouldn't be too fearful. But on the other hand, they've been successful because we've been careful. We've worked out details and worried about possible risks and uncertainties. So in the end, the committee is going to have to try to figure out how they balance benefits and costs. So let me turn to my 3 concerns. First, I just think it seems like a bad idea to have 2 forecast documents coming out at 2 o'clock on the policy date. They're not going to agree. That may be white noise, but at least in the past, there have been significant differences. So I haven't done a comprehensive study, but I looked at 6 kind of random dates in the 20-teens and looked at differences between the staff forecast and the median from the SEP. And there are differences of 2 or 3/10 on the unemployment rate, differences a little smaller in inflation, big differences in the funds rate path, actually, differences as large as 100 basis points, and 40 or 50 basis points, not uncommonly. The differences are bigger when the situation is more uncertain. So when you're far from full employment, you're far from inflation at target, you get some pretty big differences between the forecasts. How quickly do we come back? They don't necessarily agree. And those differences would get a lot of attention. It would put the focus of the thinking and the discussion, the questions at the press conference on exactly where you don't want them to be, which is, why is the staff having 45 basis points more a Fed funds rate hike over the next couple of years? So anyway, I worry about just having a confusion caused by the two different forecasts. And the differences between the review and the FOMC statement and any forward guidance in the statement would also cause confusion. We've seen this with the SEP, and I think it might be worse with the review. Why doesn't the staff believe the committee? Why doesn't the committee agree with the staff? So at that point, it'll be really tempting for the chair at the press conference to say, it's just the staff's view, right? They don't matter. What matters is the policymaker's view, but that just completely undermines the whole project. Second concern, I'm not sure the alternative scenarios will be as effective as Ben suggests. There are three possible benefits. One is it just clarifies the uncertainty and risks. So at least it makes them more palpable, right, to the public, and that's helpful. It can show reasons for risk management policies, and these seem helpful. But on the other hand, there actually, I think, is a fair amount of information on uncertainty and risks now in the SEP, and it's always surprising to me how little attention that gets. Maybe it would help. Maybe you'd get more attention if you had alternative scenarios. I'm not actually positive of that. And a staff-produced set of alternative scenarios seems unlikely to me to give a whole lot of information on the committee's reaction function, right? These alternative scenarios will be produced by the staff using a model, FRBUS or something. There's some estimated Taylor rule in the model. You could just publish that rule. I mean, if what you want to do is provide information on the reaction function, that's the reaction function in the alternative scenarios. So you could publish the rule. But that's not the reaction function of the committee. You're not really providing information on that. Indeed, I think the committee might not like publishing alternative scenarios because they could be misunderstood as providing information on the committee's reaction function, which they're not. In yet another fiasco from 2012, we went to the committee and tried to get them to provide information on alternative scenarios. They did not like it. They did not thank us. They said we would need a lot more information to tell you what we would do in the alternative scenario. One participant helpfully said they really would need another teal book for each alternative scenario. And I guess for each quarter in the alternative, we'd produce 20 teal books. One participant just gave up and said, well, we can't do this. Maybe the staff could publish a monetary policy report with the forecast and some information about the forecast. And another participant who's here today, Bill Dudley, said the public isn't going to be interested in that because they want to know what the policymakers think. They don't want to know what the staff thinks. So I'm just not sure you get as far as you might have thought with the alternative scenarios. Third concern, providing detailed assumptions about the forecast and the alternative scenarios could raise both economic and political risks. For example, if you're really worried about a financial crisis, providing a financial crisis scenario where all hell breaks loose probably isn't going to be helpful in avoiding the outcome that you'd really like to avoid. And so that could be just a hard time to decide what to show in the alternative simulations. I think providing an alternative scenario in which forward guidance is abandoned quickly could be helpful, as Ben suggests in the paper. But it would also undermine the forward guidance, and I'm not sure the committee would want to do that. For example, they could have, in 2021, even without the ability to show alternative simulations, they could have emphasized in communication the escape clause that was right sitting there in the forward guidance. They didn't do that, and I assume they didn't do that because they were worried about undermining their guidance. So I'm not quite sure you would show the alternative scenarios that Ben has in mind. And in some cases, I guess I'm just more worried about this than Ben is. The forecasts and scenarios would be seen by others as the Fed injecting itself into policy decisions that aren't the Fed's policy decisions. The Fed's emphasized it wants to stay in its lane. It wants to focus on its monetary policy responsibilities. It may be pretty hard to do that with alternative scenarios that are politically hot. And it could invite requests for additional alternative scenarios, right? You're going to tell me my policy is a bad idea. Tell that guy his policy is a bad idea. And that just gets the Fed in the middle of these debates and is a risk to Fed independence. To limit the risks, I think the alternative scenarios are likely to be kind of formulaic. But how useful would they then be? I'm not sure. Okay, so that's my concerns. 3 questions. First, as Ben said, there's a governance question here. Why the board staff, would the Reserve Bank presidents be happy with that? They'd want some oversight. I'm not sure exactly at what stage that would come. What if a FOMC member just objected, just didn't like it? You'd have to figure out how to handle that. That's where the idea for a consensus forecast kind of foundered, was how do we deal with dissents. So anyway, the committee would need to think really carefully about the governance of this and try to sort these issues out. Second, what's the timing for this material? I think there's just kind of unavoidable trade-offs here. Do you want to provide the information immediately at the same time as a policy decision? Or can you prepare stuff in advance, but then there's a lag potentially? Ben suggests the review could be done in advance. I was looking at the ECB staff forecast from their March meeting. The March meeting was March 6th. The technical assumptions for that forecast were chosen by February 6th. The forecast was finalized February 19th. So they set the policy path a month before the meeting. They set the forecast 2 weeks before the meeting. Lags like that increase the risk that the review would be out of sync with the SEP and with the policy decision. You could address that by, in effect, making the policy decision earlier, but that just means more policy inertia. I already worry that policy isn't as nimble as it should be because of the complexity of the communication around the policy announcement. So it's a hard trade-off. And again, the committee would have to try various processes and see what they think. Finally, and maybe least important, but what is the role of the existing NPR? Currently, it's the document that captures in detail the Fed's views on economic and financial developments. It provides a very broad rationale for the policy approach and provides an outlet for timely analysis in the boxes. I read the boxes first. I also eat dessert first. And so now those things would be done in the review. The NPR could provide more detail. Maybe some of the boxes would remain. But I think it becomes, I don't know, obsolete's too strong, but even less important. Communications got more complicated. Maybe that's inevitable. But I think thinking about what are you doing with the different pieces of your communication is important. Okay, so I've whined a lot about Ben's proposal. Let me give you my milquetoast alternative B. So I would focus first on improvements to the SEP, very much along the lines that Ben suggested. Get more information from the participants. There's already some. Get more. And force the participants to update their information at the meeting so things are more or less up to date. Have the staff prepare a summary document that provides background and justification for the median SEP forecast. I understand the SEP median forecast is a mongrel It could be a problem, it could be inconsistent. I don't think that's actually been a problem. The center of the committee is kind of in agreement, and I think their forecasts are pretty similar. You could have boxes on key analytical issues, maybe fewer than Ben had in his draft review, but still, you'd have some there where they were really timely and important. Leave the others for the NPR. I'd mentioned there used to be an SEP document published with the minutes. At some point, I think that got too boring even for the Fed staff. And so it was just quietly dropped. But it didn't need to be, right? You could make that a serious document, and that would require work, but it would be, I think, a helpful document. And it is the views of the policymakers, and I think in the end, the public cares about the views of the policymakers. A second step, if desired, you could use the alternative scenarios from the Teal book, and you could basically add factor the models to center them on the median forecast from the SEP. Those would be explicitly staff work, and so on. They might well be formulaic. You could try to only use alternative scenarios in situations where they were really helpful, but my guess is if you started using them, you'd be using them. Then in the end, the document would be approved by the participants. It's conceivable that wouldn't be easy, but I think it would be easier than with a staff document, since the baseline is the participants' projections and inputs. All you've got to do is make sure you're representing correctly the views of the participants. The minutes already is basically doing that. I haven't said anything about timing. The committee would have to work through the trade-offs on that and decide how they wanted to do that. But I could imagine a process where you'd start a little earlier, you'd release this at the meeting. I could imagine releasing it with some lag, but trying to keep that lag small. Thanks, I'll stop there.
All right, so questions. Let's start with Neil, and then we'll stay on this side with Marco, and then
Thanks for the interesting presentations. So I share the Bill's skepticism, and I think about it as I'm a consumer of scenarios. So I've been at the Fed now for 9 years, and I read the Teal book cover to cover. I have since I started. Staff does a fabulous job. What I find is that in moments of great uncertainty, like right now, the alt-sims are the least useful to me. I think about my own preparation coming into this meeting that we had last week. I spent almost no time on the alt-sims because we're trying to understand where these tariffs and trade negotiations are going to go. The range of outcomes are so profound, and the alt-sims are so stylized. The one thing I know is the reality of whatever we're going to experience is not going to look anything like what's captured in the alt-sims. Go back in 2020 when I was on Team Transitory. I'm guessing, I don't remember, but I'm guessing the alt-sims in 2020 did not show an inflation shock anywhere close to what we actually experienced. And so I question, in these moments of great uncertainty and great shocks to the economy, how valuable these scenarios will be to the public.
great, and then we'll go back to Marco and Marco.
Thank you. Great presentation and great discussion. Marco Del Negro, New York Fed. I wanted to ask, isn't there a concern that publishing the alternative scenario would be seen as a sort of a commitment and therefore tie the hands of the committee were this scenario to materialize? That is, if inflation, you show that if inflation is 100 basis points higher, you do this with the federal funds rate, then inflation turns out to be that many points higher, and then people will ask, well, why didn't you raise the funds as you had promised? Now, the same issue is, of course, there with the dots, but the dots are not one line, there are many. Thank you.
So can you just hand it to Mark? Yeah. Thanks.
Thank you. Mark Giannoni, Barclays. The New York Fed, I love the presentation, of course, love the idea about the scenarios. But in the spirit of thinking about the SEP and potential improvements to the SEP if they were to stay, the New York Fed in its survey of consumer expectations, I guess, asked survey participants to give probability distribution over different outcomes on inflation, for instance. The New York Fed survey of primary dealers asked primary dealers a lot of questions on different probability distributions and potentially also on the different scenarios on inflation, output, on interest rates as well. The advantage, of course, is that you can then aggregate these distributions over the different survey participant respondents, and then you can easily compute the mean, the median, of course, and you can distinguish the uncertainty from the disagreement among participants. So I was wondering if the FOMC, with the support of their staff, could also answer similar questions over these distributions and then aggregate these distributions and present them to the public as well.
That seems like a good opportunity.
Should I respond?
Yes.
Okay, so the argument basically is we have an existing system which has deep logical problems, but the alternatives are not perfect. Therefore, let's stay with the approach with the deep logical problems. And Neil's point, yeah, alt sims don't cover the range, but I think it is important that I've suggested that there be input from the FOMC to the which alt sims and what the reaction function looks like. People would know that this is a staff product, but it's also one that the FOMC agreed to release. I mean, the basic fact that, and my example about 2021, just saying, well, one of the possibilities is inflation will be higher than we thought. What would we do then? Maybe we would stop QE. If people had known that in advance, that might have been a little easier to do, for example. So also, and I would recommend, if you have a chance, to look at my review of the Bank of England. I talk a lot about other things that alt sims are useful for, like, for example, Silvana's stress testing of forward guidance and the like. And you can't, and Bill suggests, add factoring alt sims onto the projections. That doesn't make any sense. It's not. You don't know what the baseline is. You don't know what the assumptions are. And if the FOMC doesn't like the staff's internally consistent reaction functions, why was it going to like the reaction functions that come out of that exercise? So, no, it's not perfect, but I think we should be working towards sort of more analytically deep and comprehensive types of communication, and in particular, just simply getting the concept over. The headline shouldn't be, Fed says inflation is going to be transitory, full stop. It could be, Fed is uncertain how inflation will evolve. Many currently think it will be transitory, but there are these following issues. People need to understand the range of uncertainty. On commitment, I don't see why that would be a commitment, particularly since it is a staff product. It's also the case that people don't treat I think there was a lot of concern when we first started having the dot plot that they would be treated as a commitment. That hasn't happened. They change from meeting to meeting, and people understand that, and they understand it's just it's a signal, but it's not a it's not a commitment. Tobias Adrian and his colleagues have some very interesting work looking at whole probability distributions of possible outcomes. Great. Let's think about that. I just wanted to call people's attention to the weaknesses of the current system and ask whether or not there are ways to improve with the fact, the model we have that, while the NPRs for other central banks are not perfect, of course, they do suggest that they can be useful, and a lot of resources are put into them by those central banks.
All right, so we're going to do another round of questions. There's going to be more questions than we have time for. So I'm going to start with Austin and then go to Jing and then Brian.
If you want to jump in, just say so.
It seems like there are two issues. One is the alternative scenarios and the reaction function. The other is for the immediate decision, what was the basis of the decision? What did the policymakers think why do they act the way they do? On that latter, it feels a little problematic in that the committee failed at coming up with a consensus forecast. And it failed to do so because the committee doesn't always agree, and maybe never agrees. But the point one, is this de facto trying to make a consensus forecast without making it? We couldn't do it because we have a decentralized structure, which is different than most central banks. If we release a staff forecast with the decision, and the world believes, oh, this is the forecast that the decision was based on, it's fundamentally that's not logically correct. I guess that backs me into if Bill's is alternative B and the Bernanke proposal is alternative C, isn't alternative A just connecting the dots to the forecast for each of the decision makers in the SEP that we have now? That would at least be a logically accurate description of here is what the policymakers themselves thought they were doing when they said, here's what the appropriate policy would be.
Thank you very much. Sorry. Thank you very much. Jing Yang, Bank of Canada. I really enjoyed this section. I guess we are among the group of friends who jumped off the bridge. So just want to share some experience. I have two questions. One's on central projection. One is on skewness. So like Ben said, in April, in most of the cases, we try to publish a central projection as well as some alternative scenarios, upside, downside risks. But in April, the most likely scenario does not exist, because we have to close the forecast. We keep updating forecast, but the tariff scenario change every day. So there does not exist most likely scenario. So we decide to go with scenario 1, benign scenario, scenario 2, severe scenario, where economy go into recession. So anything happen would be in between. That actually landed really well, I have to say. The communication is easier than what we thought, and no one really take that as a commitment. Indeed, the tariff announcement in early April fall into between the two lines within the range. So, but that is not without challenge. So here's my question. Since we did one round without a central projection, that created the problem of how do you maintain the continuity of your narrative? Or in our own language, we cannot do shock minus control for the next round, and your scenario change all the time, and you didn't have the central projection. So we realized this is one challenge. Very quickly, my second question is about skewness. In most of the cases, we try to portray even number of upside risks and downside risk scenario. But sometimes that's just not the case. In January, the downside risk come from a potential tariff, just huge, so huge that there's no any other upside risk could make our forecast balanced. So in that case, that raises the issue for the policy action. Typically, monetary policy should react to your most likely scenario. But in the case, the whole forecast is so tilted downside, risk so tilted downside, how should you make your monetary policy based on scenario, central scenario, or taking into account the downside risk? Thank you.
Can I jump in here? Sure. I can't remember all these questions. So, Austin, so one of the issues is, does it have to be a full FOMC consensus? What I'm proposing is having a lot of input from the committee about what they think about this forecast. It doesn't have to be 100% consensus. You could have a vote, 14 people thought it was good, 4 people were indifferent, 1 person was opposed, whatever. You would have the SEP commentary. Most of the FOMC members thought this was an approximately reasonable projection, but 3 people were concerned that there was insufficient attention to a particular set of risks. Moreover, there would be, again, input from the FOMC before the meeting, during the meeting, and there would be commentary, there would be choice of which SIMs to release. This is actually more governance than in most central banks, frankly. I mean, if you look at, I don't want to pick on the Bank of England, but I just had the experience of being in, their decision-making process, and I think they've just recently changed, but they had an idea called best collective judgment. So it's supposed to be, in principle, kind of a unanimous thing. In practice, it's kind of like, can you accept this? Yeah, I don't like it, but I'll accept it. I mean, you get 19 people or 9 people, perfect. It's just not reasonable to think you're going to get perfect agreement. But is this a reasonable description of what the committee thinks? That's a criterion I think that could be operationalized, and that's important. And then several people raised the question about risks. So Alan Greenspan invented this concept of risk management. The idea that if there's a huge risk on one side, that then the sort of, risk neutral rate path needs to be slanted a bit. And alternative scenarios are a good way, and this is what, again, many central banks do. I thought what the Bank of Canada did was very innovative. Let's look at the case where tariffs are 100%, and we could use it as a stand-in. Maybe inside the bank they do 3 or 4 other, variants, but they just sort of qualitatively assess the effect. How big a risk is that? And what's the judgment of the committee about, how much you should deflect, policy in order to accommodate that risk? So, yeah, again, this is not going to be perfect, but once you start looking at the projections, I just have this strong desire to try to find a better way to communicate, understanding that it's never going to be unanimous. There's going to be a center of gravity, and there's going to be a consensus, or perhaps, or a consensus among a majority. But going for a strict consensus is probably not realistic in any context.
If I could just step in for a second, I think I like the idea of getting to a forecast that the committee decides they can live with, and a set of alternative scenarios that the committee decides they can live with. But I wonder if putting that on the staff forecast is really going to do that in a helpful way, unless the staff forecast, by kind of design principle, is very similar to the views of the committee. If the staff has a different view of the outlook and a different view of what appropriate policy is, I guess I don't know how we close that circle.
Except that never happens.
Well,
except for the white noise element.
I guess I'm not convinced.
I don't recall any time when there was a radical difference between what the Teal book said and what the thrust of the committee was, and partly that's because the staff know what the committee is talking about and thinking about, and they incorporate that in their projection.
And certainly in the late 90s, the staff was much more worried about the economy overheating and high inflation and a need to tighten policy, and Greenspan was saying no, productivity growth was faster and there was no need to do that.
But the consensus of the committee agreed with the staff. And they were wrong.
But not what they
agreed.
did. not the revealed preference of the committee.
Okay, so I believe there's a two-handed question from Chris, and then I think we're going to unfortunately have to cut this. We're already 5 minutes into our break, so carry all of your questions over to the policy panel, which will be next, and so that we can continue this conversation through that panel.
Yeah, I was just going to mention for Ben, there was a case in '23 where the staff, after the SVB and the banking situation, the staff was predicting a recession by the second half of the year, but basically most of the committee did not agree with that assessment. It wasn't that there was anything wrong with it, it's just, we just didn't think, we had different views of how tight credit conditions would be, how well the bank term funding facility would work. So we did have this case, and then if that's public, then there's a confusion about, why are the staff saying this and none of you believe it? Are the staff incompetent or what? This is exactly the problem you run into when there's a disagreement. Now, you're right, most of the time it doesn't happen. And I also just want to make one comment on, when you do put the staff forecast out, which in general I'm kind of sympathetic to, it's just too easy to then push the blame for mistakes onto the staff forecast. In 2021, if we had shown that, look, the staff forecast said this was transitory, it wasn't going to happen, and then it failed, we could have easily said, well, we were just going on what the best forecast of the staff was. It really wasn't our decision. At the end of the day, it's our responsibility for those decisions. Sorry for the soliloquy.
I forgot to compliment you, Governor Waller, on your speech with the two scenarios in it and explaining how the Fed would react under two very different sets of factors.
All right, so thank you all very much. This was really a wonderful discussion.